of you guys have heard there is a tax bill that's floating around out there. We needed to tell you what's noise and what do you actually need to know.
Now, Brian, I am so excited to talk about this because we know that the financial landscape is ever changing and there are only a few certainties in life: death and taxes. And this is super interesting because right now it sounds like there could be some tax changes coming down the pipe, and we want you to know what they could be and how they might affect you.
Now, I'll throw the dash of money guyism out there is that we typically don't like to cover anything until it comes through both sides of the legislative process, both the House and the Senate. But there's so much out there in the news media. I told the crew, I was like, look, we got to cover something just to let people know. So just so we can express the fact that this still is only half baked. We've got to get it through Senate. There's going to be horse trading. The political process is always a mess. But I needed you guys to at least know some of the broad themes that are going on so you can go ahead and start preparing yourself because it will move fast. Once the Senate and the House start doing their negotiations back and forth, it will start moving faster. And we want to kind of give you the overarching parts that you can start planning for your personal finances.
And don't you worry, when we actually have law, we're going to cover that. We're going to do a deep dive to let you guys know what's in there. But as we were thinking about this legislation, we're thinking about what would be an interesting way or an easy way to sort of lay it out for you. And we thought about the personal income tax return. And when you think about your personal income tax return, there are really sort of four sections if you want to think about how it's broken down. You have the money you make, that's like all the income sources you have. Then you have the part where you get to reduce the money that you make, or at least what the IRS recognizes as the money you make. Then there's a calculation that takes place that determines, okay, how much tax do I owe? And then there's a part of your tax return where you can actually reduce the amount that you owe. That's where credits come in. And so we thought about, okay, if these are sort of the four broad sections, very generally speaking, of a tax return, how do some of these tax changes, potential tax changes, hit each one of those sections?
Now, the first one is the money you make, gross income. We don't really have a slide on this one other than the headline because this is where you see everybody talks about, is tip income going to be taxable?
That's the big one,
Is Social Security going to be taxable? Remains to be seen. Like I said, we're only half baked. We've got the House bill. We do not have the Senate bill. I will be curious to see, but we didn't want to put any additional slides on this until we got the full details from the Senate once they get through the negotiations.
So then when you move down from gross income, you get into, okay, well, how much income does the IRS recognize? Because it's given us some things that will allow us to decrease the amount that our taxes are computed against. And so one of the big things, and a lot of what this bill is there was some tax legislation that came out in 2017, the Tax Cuts and Jobs Act. And a lot of what this legislation is it saying, okay, are we going to allow things that changed in 2017 to expire, or are we going to allow them to remain? And one of the big things that's going to hit a lot of households is the standard deduction. For those of you that don't know the language, when you fill out your tax return, you have two choices. You can either take the standard deduction or you can itemize your deductions where you get mortgage interest and state income taxes and other types of items where you can create your deduction list, or you can just take the stated standard that the government allows each year.
Now, look, we've pulled the stats. 90% of taxpayers actually use the standard deduction. So this is a big deal. I would say the big driving factor for why we even need updated tax legislation is because look at what happens to the standard deduction is it basically gets cut almost in half if we don't bring back, or make these changes permanent, because they all sunset, which means they go away at the end of the coming year of this. It's actually this year.
That's right.
So for years, I've been saying 2025 is when here we are living in it. So that's why we know that something will happen, is because, politicians, they know that, taxes going up is less than ideal for getting elected. So that's why I think that you will see bipartisan, they will want to do something just because they want to keep the people happy.
So if the legislation passes, it does seem that the standard deduction will increase for single individuals from $15,000 to $16,000, for married filing jointly from $30,000 to $32,000. And there is an additional senior standard deduction that is currently a $2,000 addition that if this passes, it'll go to $4,000. Now, it is important to note that this increased standard deduction, the little cherry on top, is only set under the current proposed legislation to go from now until 2028. So they're kind of even kicking the can down a little bit further in terms of when they're going to lock in.
But long term, this would make those changes permanent.
That's right.
So the standard deduction would stay at current levels instead of sunsetting like it's done in the past. But they put a little juicer in there, probably for political purposes.
That's right. So now that's the standard deduction. Whether there's a other part of the population that itemizes their deductions, where essentially they calculate some of the allowed expenses that you're able to deduct against your income. And probably the most significant change that has been talked about that will likely be in the bill in some form is the SALT deduction.
Yeah, for those that don't know, years and years, if you live in a high tax state, the only consolation prize you got was, hey, at least it's deductible. So a lot of people, then the tax bill came out in 2017 that actually now put a cap, and it said, look, you only get to deduct the first $10,000. And this is not just your state income tax. It's also your property taxes on all your local taxes. So you can imagine this made some waves if you lived in one of those high tax states. And it doesn't, by the way, it doesn't even have to be high. You could just be in a high property tax state. And all of a sudden you get captured where you're limited how much you could deduct. Well, they've listened to some of the criticism, and they've actually expanded this under the proposed legislation to $40,000 cap, with the caveat that it starts phasing out once your income is over $500,000 back down to that $10,000 cap. So this will allow people to expand that if you live in one of these higher tax areas or you pay high property taxes. It looks like the SALT deduction is going to get expanded to a degree.
And so then the next change, if we think about working through the tax return, you have the income you make, and then you have the income that the IRS allows you to recognize. Well, then you actually have the tax computation. How are they calculating what you owe? And one of the, again, significant things that has been talked about is whether or not tax brackets are going to change. And as a reminder, the brackets did change with the 2017 legislation. And if that legislation is allowed to phase out, they will revert back to the rates that were in place prior. But if the new legislation passes, it's going to lock the current rates in. And what that means is that the highest marginal tax bracket is going to be capped at 37% as opposed to 39.6%. But even inside of how they expand the tax brackets, there's going to be a change each year.
Yeah, I mean, this is the one, if you take into account the standard deduction and then the tax brackets, this is the one that's going to capture the majority of taxpayers. Plus, we'll get into credits in a minute with the child tax credit. But this is the stuff. Once again, it's the theme of this legislation is to make this stuff permanent if they actually make this happen.
And so now we're going to move to the last section. So it's income that you make, it's deductions, it's then how you calculate it. And the last thing is how you actually reduce your tax bill. And one of the most significant tax credits that a lot of American families are able to take advantage of is the child tax credit. And there is some proposed legislation inside of the bill suggesting that there will be a change to the child tax credit.
Yeah, this was child tax credit. It's pretty much been doubled. I mean, you can see if it phased out, it goes back to $1,000. It's currently been $2,000. Now, once again, under the new bill or the proposed bill, there is a sweetener in there that's going to phase out in 2028. But the overarching theme for long term is just to make the doubling of the child tax credit permanent. And I thought that the other interesting thing, if this legislation passes, it is going to make these child tax credits now index for inflation after 2028 once they lose that sweetener on there. But I think a lot of taxpayers, this impacts a lot of your taxes. If you have kids, what a big deal this is, because credits are different than deductions. Is that these are not, you get a deduction, and say a deduction gives you 30% off or even 50% off, you still pay taxes on the other 50% or the 70%, depending upon what the deduction and your tax rate is. A credit is a dollar for dollar reduction in your taxes. So these things are actually bigger impacts on how much in taxes you pay, because that's a literal $2,000 reduction in the taxes you pay. So you can imagine, if you're a parent, this is something you'll want to pay attention to.
So what should you change? How should you alter your financial plan today? Well, realistically, it might be a little premature because, again, we don't know what the final legislation is going to have in it, but we do want you to be aware that these are the areas that are most likely to be impacted. So if you are someone who would be impacted in one of these areas, we just want you to pay attention. We want you to recognize that changes could be coming down the pipe, and we want you to be prepared for them so that you can either plan for them or position yourself in such a way that you can take advantage of.
And don't worry, we're going to give you the full details get all into the nuts and bolts of this once we actually know what the real consolidated bill from both the Senate and the House. We've only got the House to this point. And that's where we'll be able to talk about the tax on tips, the Social Security. How about these savings accounts? I mean, that we're talking about putting $1,000 for all newborns. I mean, it's almost like somebody woke up. I'm not getting into the policy idea, but it is one of those things where if you go to moneyguy.com/resources, we do have a resource on how powerful is your army of dollars. It's essentially a wealth builder by a wealth multiplier by any age. And for a newborn, if you look at how much you have to put in, every dollar you put in for a newborn is 647 times.
That's incredible.
It's pretty powerful stuff. If they did, but I've never realized I've lived long enough through politics that you remember how it was under, I think, President George W. Bush, that they talked about turning a portion of Social Security into private industry and index funds. So that might be something that it remains to be seen what actually comes out. A lot of it is conjecture until we get the actual consolidated bill.